Well, folks, we might be at the beginning of a doom loop of a liquidity crisis. And in this segment, we're going to explain what that means and what that could mean for the stock market. Now, we've been talking about these potential liquidity issues over the last few weeks on the channel. In fact, if you've been watching the warnings we've been talking about, none of this should be a surprise. In fact, starting about 2.5 weeks ago, we started flagging the FMS, the Bank of America Fund Manager Survey. Now, these are their words, not mine, but look at them yourself as a reminder. I keep in mind, these screenshots are all in the Meet Kevin app, which you can download for free on Apple or Android. You get the Daily Wealth and the other. It's totally free. You can see them there. But anyway, the Bank of America Fund Manager Survey average cash level has declined from 3.9 to 3.8%. This was posted mid-October, about October 16th. The sell signal for the Bank of America Global Fund Manager Survey was last triggered in July when cash fell from 4.2 to 3.9%. If we sit at or below 3.7, we move to a hard sell indicator. Now, right now, in the last survey that came out the last week of October, so fast forward about 2 weeks, we dropped all the way down to about 3.8%. Now, this is old news. We kind of already know this. I just want to catch you up on this. Usually, when we get to these low levels of cash available, people start becoming, frankly, unable to buy the dip. A recent example, or actually a few recent examples of where we had more cash available to buy the dip, and then we had Nike swoosh style recoveries, were Liberation Day. We essentially Nike swoosh straight up from there, right? S&P up like 30+% from there. Cash was much more available. Take a look at October 22. This is roughly when I bought my Nvidia shares, which, are like massively up. But I bought the dip on chip stocks in October of 22. In fact, I had a fund that was basically had a huge allocation to chips. And I'm like, guys, this is like, we're in a chips recession. This is the perfect time to buy chips. Look at where cash levels were in October of 22, around 6%. Way higher than where we sit today, or even the COVID low of April 20th. So it gives you more recent sort of memory examples of when those cash levels are higher, we can usually sustain a larger rally up. Right now, we sit at a very low level, which roughly aligns with the end of 2021, roughly aligns with other pain points where historically stocks haven't necessarily performed the best. It's only one signal, it's not the only signal. That's the Bank of America Fund Manager Survey. Another signal that we paid attention to in the Course Member Alpha report this morning, where we set up our strategy for the day. In fact, I'll tell you what our course member strategy was this morning. I'll just break it down for you. You can take it for what it was. But one of the things we looked at this morning was actually a dangerous double top. Now, this is not broadly on an index. This double top that formed, this is just an example of, this is a really low resolution, crappy image of what a double top looks like. And then it usually continues with a fall off the cliff to the right side, right? This dangerous double top has actually formed on a company that I think is exceptionally profitable. It has a relatively low PEG ratio. We're at about a 2. So frankly, it has about 20 to 30% upside in the stock based on where its valuation sits and its growth forecast sits and where forecasts sit and where its margins are. This is a company that, first of all, I highly respect the CEO of, and the valuation's fair. And what company just had a double top on the day chart? Microsoft. That is another indication of liquidity concerns going into, of course, the Palantir earnings we had yesterday. There's a reason why in my video yesterday I called Palantir earnings critical before the earnings came out. Because it's a sign of, will there be enough liquidity to keep the pump going? We've obviously extended on sort of this like euphoric tip over here. And clearly the answer is no. There's not enough liquidity to keep the pump going. So start adding these things together. This bizarre double top on Microsoft, I don't think is idiosyncratic, because when you look at the company itself, the numbers are great. So you have a double top on Microsoft. You have a euphoric tip on the Qs your triple Qs, your NASDAQ 100 tech index, and on Palantir. So you've got that euphoric kind of rotation up, the double top on Microsoft with the euphoric rotation. Then you have the fund manager survey, which is a red flag of liquidity. Bitcoin's price only moves because of liquidity. I will explain more on Bitcoin and MicroStrategy in a moment. And then number 5 catalyst is actually what's happening with funding rates, especially at the Federal Reserve. Take a look at this. If you subtract the SOFR rate from sort of base international rates, you can see the delta of how liquidity is funding up or drying up in the banking sector. Now, this is actually a pretty big red flag, but it's early. Broadly, it's not enough of a liquidity issue yet. But here's the self-fulfilling nature that could happen. The doomers point this out really well. They say, liquidity concerns are the sort of thing that can become self-fulfilling. Even if an institution has ample liquidity on its own balance sheet, let's say JP Morgan and Chase, stress elsewhere will lead to the tendency to hoard liquidity until there are better opportunities. So the problem with this credit cycle that we're in right now, which I didn't think would come this early. We know the cockroaches are a problem, but I thought we might still be okay until at least the government reopening. The problem that we face, though, is the sheer number of warnings we're getting on credit risks are becoming concerning. And that's what's changing the game here. It's not just what you're seeing at the repo markets, which yesterday we had another surge in repo demand. Now, in the grand scheme of things, is $29 billion or $14 billion plus 7, are these numbers, well, I guess that's 49 versus, $21 billion over here. Are $49 to $21 billion of repo stress really that big of a deal? In the grand scheme of things, they're relatively small numbers, right? But you have to go all the way back to COVID to see the credit stress for any of this to actually matter. If we go back to, or like 2008, this is kind of when you start seeing credit stress because you have a big gap over here. This literally jumps from 2018 to like 2019. So we don't actually see, there should be a giant white gap right there, but they just deleted that. I don't know why they do that. But if you zoom in a little bit just to make the dates make a little bit more sense, there we go. You can see we've had no liquidity issues except for once very briefly right here this summer, and that's it. And lately they've been ramping up again like in COVID. And that's why that delta chart is so concerning because it suggests that there could be a self-fulfilling start to credit concerns. See, UBS is warning of looming credit risks from credit ratings, which I hate to say it, but sounds very 2008-esque. He literally says, there is now a growing chorus of voices pointing to risks in the multi-trillion-dollar credit rating industry and the insurance industry. Because basically, rather than using big credit rating agencies like maybe Standard & Poor's or Moody's or whatever, rather than using the big and expensive companies, you can actually now just call up, quote, small rating agencies to check the box of regulation and then just share those private ratings with certain issuers and investors to get debt or investments. And you don't actually have the reputation of a large credit agency anymore. You have the reputations of a bunch of small credit rating agencies rating debt, which just amplifies the potential risk of the private credit bubble. Now remember, people are like, oh, but private credit doesn't affect the banking system. Wrong. The IMF tells us that 90% of lending to private credit comes from big banks like JP Morgan and the other big boys. They just get done through convoluted, assortments of capital, which is scary. So now what you have is not only this Tricolor and First Brands collapse or some of the other issues that you're finding in private credit. We just saw Renovo Homes go bankrupt, taking out a bunch of smaller contractors in home renovations. But you're also finding that this is going so extreme that credit agencies were actually giving First Brands and their auditors were actually giving First Brands good reviews good ratings, good audits, or passing audits. Mind you, First Brands didn't use a PCAOB audit, which I think is very important. This is your highest standard of auditing. They used lower standards of auditing. But look at this. The company First Brands is now literally suing their founder because the CEO funneled up to $700 million into his own mansion, into his fleet of 17 exotic cars, a celebrity personal trainer, $3 million of luxury rent for a townhouse in New York, $500,000 to a private chef. And what's concerning to me is not that that's the kind of scam that happened at First Brands. It's that the non-PCAOB auditors apparently missed all of that. And apparently the credit rating agencies missed all of that. I mean, it goes so bad that they literally talk about certain invoices saying that, First Brands actually sold products worth $11.2 million that you could finance against, when the reality was the product was only worth $2.3 million. That's a scam. That's fraud. It's no surprise that there's fraud here, and the CEO, if this is true, should go to jail. The question is, or the bigger concern is, wait a minute. What if that means there's a lot more uncovered fraud like that everywhere else? And that's why you're starting to see these funding stresses create concerns, because these are signs that other banking institutions are going, you know what? We're just going to hold cash. We're going to see how many cockroaches are out there. And once you get that tightening of credit, that's when the true problems happen. Now, we're not quite there yet. Excess liquidity, if we look at excess liquidity charts, we're flat on excess liquidity, so it's not like we're super low on excess liquidity. And on top of that, we're not in this place where credit spreads are signaling some form of massive dry up in lending yet. You can see that here. Credit spreads are still relatively tight, which is bullish. You could see financing costs are rising, but we're not like skyrocketing, and we're still seeing a generation of commercial and industrial loans. The problem is this chart only goes through the third quarter. So we don't yet know what stresses are going to show up in October. So these are things to pay attention to, but we could see the seeds of a credit crisis and a liquidity crisis are real. So what did we talk about in the Alpha report this morning? Well, I made I had a very clear, we spent probably about 30 minutes coming up with a strategy, in the actual stream. And obviously it took me a lot longer to prepare it before my stream, because I try to go into the streams prepared. So when people come to the Alpha report, we're like, okay, Kevin's already going to start by talking about, here's the game plan for today. And that's basically what we do. So, we start our course member live stream, we go live, and I break down, here's the game plan for today, here's what's going on, here's what you got to watch for, here are the traps, and here's my strategy. So what I said in the Alpha report this morning, which you can get that at meetkevin.com, we've got like a quiet code that you could use. It's NVDA for NVIDIA earnings coming up. It's going to be a bigger deal next week and the week after when we get towards NVIDIA earnings, which is really the end of our catalyst for earnings, by the way. They actually had pretty damn good earnings. Like Palantir earnings were good, it's just their valuation is kooky. The only way you could keep the valuation going is by having loose liquidity. So anyway, the strategy we had this morning was we need to see if the Qs can make it to 630, otherwise bearish. So what happened? We made it to 627 and then we started bleeding. Volume started declining, the Qs gave up. We're basically at the same places where we were at the open. And our strategy was, I'm not interested in buying the dip unless we can prove 630, because proving 630 means we have enough liquidity in the market. If we lose 630 or we have a sell-off at either the end or beginning of the day, that exacerbates liquidity stress, because now people are like, crap, I got to pay off margin, I got to pay off debt, and they don't have money to buy the dip. Then you could actually end up getting more of a dip over time. So that's just an example of what we talk about in the Alpha report and how we set that up this morning. And so far, that seems to be exactly what's going on. Now, what does this broadly mean? Well, near term, we shouldn't really be having a sell-off on fear over jobs. I mean, in fairness, the ADP report expectations are all over the place for tomorrow. ADP expectations literally imply that no one has a clue. Like I literally wrote that here. Nobody has a clue. Now, the standard deviation on this is 27,000. I'm sorry, it's less than that. I think I can't remember what actually, it might be 27,000, but let me check. The expectation is that we're going to get a 40,000 jobs read on ADP, but look at how diffuse the economist estimates are for ADP. You've got some people sitting at 60, 64, 68, which would be great, but you've got some economists at negative 20,000. You know, any negative read would be terrible, but there's no consistency here on what people think. It shows that people are even more confused with what's going to happen. The standard deviation, yeah, it's 26,470. All right, so about 27,000, 26,000, whatever. 6 or 7, somewhere in there. So the estimates are all over the place. This data comes out at 5:15 in the morning tomorrow. I don't think that this is why the market is concerned, though. Now, if we get a really bad ADP report, you know, if we come in under 0 tomorrow, it's going to be bad. Anything over 0 is actually positive tomorrow because we'll be within break evens. But if we get something that's negative, then there's a real sign that we've done an oopsie doopsies with the Fed and they are behind. See, I tweeted this yesterday. You can follow me there at RealMeKevin if you want. But anyway, wow, first person at the Fed who understands this. And it's, quote, Fed Daily says if you wait for the job market report to show weakness, you're already behind. Correct. You're already behind. What are we seeing on state unemployment claims data? State unemployment claims data is showing us that at the end of September and at the beginning of October, we're starting to see pickups in unemployment filings. In addition to that, we had a lot of layoffs in October. Now, what happens when you have a stabilized job openings rate and layoffs rise? Well, when you have a stable openings rate and layoffs rise, the only place this curve goes, these purple dots, start going to the right. And then you get what's called the normalization of the Beveridge curve, which is bad because when the curve starts going out to the right, the unemployment rate skyrockets fast, like really, really rapidly. You don't actually need to see much of a decline anymore in the job openings rate. You just need to see layoffs. And then the skyrockets to the right really fast. So broadly, this liquidity issue that we're facing is all related, in my opinion, to private credit. And because of these private credit issues, you're seeing less support for Michael Saylor's Bitcoin buying strategy. Literally, his company is now named Strategy. So if you look at what Michael Saylor is doing, you can see that Michael Saylor, just as based on this quote tweet here, acquired $45.6 million worth of Bitcoin at 114,000. Okay, fine. So we're down 14% on that, but whatever. They're still up on their average cost, right? Their average cost is $75,000. And they don't really have bonds due for a few years anyway, so you would really have to see a true collapse in the price of Bitcoin to see Michael Saylor have any problems. Now, I personally think, and this is my opinion, this pisses off a lot of people in crypto, but I hate to say it, I personally think the only way you get to the true value of Bitcoin is when the treasury companies go bust. I hate to say that. I hate to say it. I've been saying it for years. And that's not to say like I'm bearish or making a directional bet in the short term. It's just to say that once that liquidity support dries up in crypto, that's when you actually get to more of the true value of what Bitcoin's true value actually is. Because you lose that order book support. You have to think about all these treasury companies as really like peg legs propping up the value of Bitcoin, not actual like demand. Because what you're doing is you're breaking the piggy bank, which is a piggy bank that doesn't last forever, right? You are taking the piggy bank of the stock and you are breaking the piggy bank of the stock to fund Bitcoin purchases. But it doesn't last forever. What happens when the piggy bank runs out of shares to liquidate? Like, in other words, the shares go to a very low value. Then you can't pay your debts back. Then you go bankrupt. Then you don't support the purchases of Bitcoin. Then you might actually have to start selling Bitcoin just to pay back your debts. And then you have problems. Obviously, that's like the doom or bear scenario. But the point is that if you actually look at the numbers at MicroStrategy, you can see that fundamentally the business cannot pay all of these payments based on the money they make. First of all, look at this. The dividends on just the preferred stock alone in the last 3 months 3 months of dividends for their preferred strategies and in their other funds, and Strike and the Strive and all these other like feeder funds that they've created. Their gross profits on their software of $90 million, their gross profits do not cover their dividends on preferred stock alone. Now, if you actually look at net income, well, it's even worse. Now, I'm not going to use the unrealized loss here on digital assets, but if I look at their net income, I could take 90.6 minus 29.9 for sales and marketing, minus 22.6, minus 38.1. It's literally zero. What? Did I do that math wrong, or is that literally zero? I mean, mental check here, 40, 60, 30, 60 plus 30 is 90. Yeah. Dude, if you literally take gross profit and subtract just sales and marketing, research and development, G&A, it's literally zero. So they make no money, which we could have already known that by going to the cash flow statement. The cash flow statement makes this obvious. Their cash from operations is negative $45 million. Their free cash flow is negative $72 million in 9 months. And the only reason they were able to buy $19 billion of Bitcoin, which they were able to purchase right here, is because they got proceeds from convertible notes at $2 billion, proceeds from selling preferred stock under the other entities that they have, and proceeds from selling MicroStrategy stock. So in other words, if MicroStrategy stock goes down, the peg leg of Bitcoin liquidity is gone. And then it goes down. It's really simple. Liquidity is nothing more than an order book. You have to understand order books to understand liquidity. I don't know that I really want to explain order books right now, so I probably won't. But if you don't understand how an order book works, maybe start there. Okay, we actually talked about that this morning in the course member live stream, but that's more educational. You're welcome to watch that. It's meetkevin.com. But I think another, and this is, I don't know if this is another symptom of liquidity, but I want to mention it. So I think another symptom of liquidity could be that we're seeing a lot of people diversify into house hack. Now, I'm not trying to make that a pitch. And just to be clear, this is not a solicitation. If you want to invest in house hack, you go to househack.com or reinvest.co. Read the offering circular. Every investment has risk. Okay. But I believe that what we're seeing is this skyrocketing of investments into house hack, partly because people look at it and go, it's based on, the company's valuation is based on an August of 2024 valuation. So imagine the stock market was frozen in August of 2024 when the company had way more expenses and way fewer assets and no AI strategy. And that's what people are investing in at now, including myself. I'm buying shares before the end of the year because I'm like, this is great, right? It's like this frozen in time valuation. And so I think because people know that and they know it's backed by real estate, they look and go, okay, well, we're going to diversify away from stocks at all-time highs. And so when we get these red days, people are diversifying away and they're like, I need to diversify. And so on these red days, I feel like it's like a liquidity signal. People are like, okay, it's red, take some money off the table, let's diversify a bit. And who knows, maybe they're using some else to pay down cash or pay down debt or hold cash or whatever. I don't know. But, we raised $1.5 million last month, which is insane. I think that was like our highest month this year since we started. I think maybe second highest. And then, I think I would probably cross $500,000 today for November because we were over $400,000 for the first 3 days. That's Saturday, Sunday, Monday. We were over $400,000, which is wild. Which, on one hand, you could argue, wait, doesn't that imply more liquidity? Maybe. But I actually think it's people selling other assets and diversifying away from things at all-time highs, like what we saw with the Palantir numbers, right? We went into Palantir with a euphoric spike and like an 8 peg and a lot of trader momentum. So it's no surprise that you're moving down on Palantir post even good earnings. But this is a sign of liquidity. If people had more cash, the stock should be going up on those earnings, not down, which is convenient for Michael Burry because obviously Michael Burry, he's now shorting NVIDIA and Palantir, but he disclosed his shorts as of, I believe, September 30th, the end of Q3, which means he's actually still upside down on his shorts if he had those shorts as of September 30th, assuming he bought them the very last day of the quarter, because NVIDIA and Palantir are still up from the end of that. But some people see that as potentially a sign that Michael Burry thinks this is the next bubble. I don't know what would give that away. Maybe this, post about the capital cycle ends with a shakeout and a consolidation. Okay. Basically how everything is leveraged to the tits. I mean, I showed Palantir's assets yesterday, and I don't know what people were talking about with leverage to the tits. All I saw was leaked footage of Palantir's balance sheet. And all I have to say is, damn, those assets are hot. Okay, that's it. That's all I got to say about Palantir. The assets were hot. Beautiful balance sheet. I mean, nobody knows a balance sheet better than I do.
Kevin is much more interested than most people, by the way, in the balance sheet.
Michael Burry tells us that growth rates for the prior 5 years at companies like Amazon, Alphabet, and Microsoft have basically peaked. Microsoft actually being the least of the issues in terms of declines relative to 23, 4, and 5. So he's arguing that people are taking on all these billions of dollars of debt via bonds or feeder fund bonds or whatever to fund this CapEx cycle while their actual cloud segment year-over-year growth is collapsing relative to the historic average. Now, in fairness, back in 2018 to 22, those were COVID days, so your average could be pumped up by COVID numbers, right? So maybe it's not that fair to compare to those periods of time, but, this gives you sort of a balanced view on Michael Burry here. Now, of course, I can't reply or quote tweet any of these damn Burry posts short of taking a screenshot because the bastard blocked me. The bastard blocked me because I showed him an eggplant. That's it. I replied to him with an eggplant emoji and I got blocked. So who's the real weenie baby here? Anyway, all of it right now markets expect that liquidity can keep booming. I mean, look at this. Anthropic projects $70 billion in revenue, $17 billion in cash flow in 28. Dude, people are pulling numbers out of their ass to keep numbers going. Now, maybe it'll keep going. But, to project out 3 years or 4 years or 5 years for LLM products that could become commoditized, just like Satya Nadella warns. When the CEO of Microsoft is saying, all your crap might become commoditized, but we're going to make money off the commodity anyway because we're going to be farmers like the farmers farming soybeans, it's kind of a warning sign that maybe some of those numbers are just speculative pie-in-the-sky numbers. But people are in pain. How do we know people are in pain? Well, because CZ tells us that when Bitcoin's down 13.7% from all-time highs yesterday, he tells us that people are in pain. But then again, Donald Trump doesn't know CZ, so maybe, even though he got pardoned by Donald Trump, and even though CZ is helping fund and promote the World Liberty financial token, which is basically bailed out by the feeder fund called Alt5, which is also a scam. I mean, it's a publicly listed stock, which happens to have a support level at 0 because I expect it's going to go bankrupt and delist because it's a scam. I mean, because it's just going to come upon hard times. We really end up with a big question of, do people have, this is what it all boils down to. Do people have money to buy the dip or not? And unfortunately, if banks tighten lending because of this private credit crap, we haven't seen it yet, but we're starting to see it. The signs are starting to come. Then unfortunately, even short-term bullishness could be misplaced. Now, you know me. I'm not like a 10 out of 10 on the bear bull scale. I'm pretty mid-range. The reason I'm mid-range is because I believe in the short term, absent, some credit crisis, we should still be bullish until the government at least reopens because we just have a lack of data. And there really are good earnings. But what's weird is we're now coming off really good earnings and big credit warning signs. Now, a lot of people discounted this October 31st spike, and they said, oh, but Kevin, that was just because of the end of the month. Fine. Then how do you explain November 3rd's spike at roughly half of that spike? Sure, it's not as high, but it's still way higher than what we've seen. So take the end of the month out. Yesterday was literally the highest spike here. And this spike is still growing. You can't really look at this one yet. You have to wait until tomorrow to see the full funding for November 4th, which makes intuitive sense. The day ain't over yet, so how do we know how much funding has been used yet? So broadly, there are real issues. Liquidity is the name of the game. In order for stocks to keep going up, you need buyers. In order for Bitcoin to keep going up, you need buyers. But margin is at all-time highs. What if everybody's already margined, max level margin, and we just can't do any more margin? Then there's no more money. I can't tell you how many of these brokerage apps, Robinhood included, send notifications going, hey, guess what just went down because the Fed cut? Margin rates. Want some margin? It's insane. Robinhood will show you your buying power is like 4x your cash. And these are like crazy numbers. Like I think my buying power on Robinhood, just the Robinhood app, it says my buying power is like 30 or 40 million dollars or whatever it is. I'm like, this is retarded. Like that's exactly how to go bankrupt is maximizing your buying power and then the market hits a down cycle. It's insane. That's just Robinhood. I see it on the other apps too. I get the notifications on the other apps that I use. I'm like, this is crazy. So it makes sense. Now here's the strategy that I would watch for, okay? So here's the game plan. All right. The game plan is simple. To understand the game, got to make it to the end of the Me Kevin videos. But here's my take on the game plan. So first things first, show up tomorrow at 5:15 a.m., okay? Come to the live stream and then join the Alpha Report at meetkevin.com. You could use that code in video. All right. So tomorrow we have the ADP stream. My opinion is that if we get anything under 20K is immediately going to be seen as recessionary, very bearish, okay? Now, anything under negative 20K. My bad. I didn't mean to put the dollar sign there. Anything under negative 20,000 is immediately going to be seen as recessionary, okay? Anything close to zero will be seen as acceptable, okay? And anything, let's go, so this would be more like plus or minus. Let's go plus minus. And then anything over 20K is bullish GDP, bullish bear bull scale, neutral on rates, but, bullish economic growth and soft landing or, whatever we want to call it, right? So the current estimate is 40K, which suggests we are going in bullish. So the surprise factor will be the left tail, right? So down. The surprise factor is leaning to the downside tomorrow because estimates are already so enthusiastic, right? That's not great, but who knows? I mean, we'll see. We saw that the estimates are very, very diffuse, but that's the strat. Now, the other thing that you need to watch for is you need to watch for institutional liquidity. Then watch institutional liquidity. What's institutional liquidity? Institutional liquidity is market on open and market on close trades. So like if you see a giant tank at the open or close, that's a sign of a lack of institutional liquidity. It is a red flag. If you see a benign close, inflows into the close, it means people have money. This is why today I said in the Alpha Report super clearly to everybody who's part of it, thank you for being a part of it. By the way, people have been asking in email, they're like, okay, is there going to be a better price Black Friday? We guarantee that if you buy the Alpha Report now, you will have the best price. So whatever happens Black Friday, that's worth knowing. Like you'll be guaranteed in at the best price. So anyway, the reason we wanted to watch 630 was because it's not uncommon to get these sort of like faint-hearted buy the dips right here. You really need to confirm that into the close. So if we can rally into the close, great. Happy with liquidity. It's a great positive sign. If we can't rally into the close and we actually bleed into the close, it just amplifies the liquidity issue. The same will be true tomorrow, except tomorrow's will be amplified by the ADP report. There you go. So, there we go. That gives you a nice breakdown of exactly what's going on. So somebody here writes, my broker is prompting me to link my other accounts to expand my margin, even in Canada. Wow, dude. So if you link your other brokerages, they're basically saying, hey, we'll go lend against the securities in those other brokerages as well, so you can maximize your margin over here. Man, that just sounds like a disaster, because what if they have to liquidate cross brokerages? Oh man, dude. It's the brokers and the FINRA system itself that's margined so badly. That doesn't make any sense. The brokers and FINRA don't take out debt for you. You take out debt. That's not a logical argument. Just because the system says, hey, Kevin, come squeeze these titties, doesn't mean I'm gonna do it. Because it's gonna be bad for my marriage and my children. I mean, if you take out all that margin, it's bad for your brokerage account, right? Like, just because the opportunity exists doesn't mean you squeeze the squoze. Crazy thought, right? So let's see what else he's saying. Some of you have Michael Burry comments. Definitely liquidity. Cash and cash equivalents are running. Look at Dixie and bonds. Yep. Yeah, and keep in mind that it is a little bit of a confusing signal that we are seeing so many inflows with house hack, because like if liquidity is drying up, why are house hack inflows so high? I believe it's because like if people say, hey, stock's at all-time highs, I'm going to sell $500,000 of NVIDIA, let's say, at a profit, and I'm going to put $100K into house hack. I think that's what's happening. Like the reason I think we see more liquidity is because people, A, want to diversify, B, they want that valuation from AUG24, and C, it's kind of just part of like a broader cash raise strategy. Like when stocks are going straight up, and there's so much liquidity, you kind of just like keep going with the boom of the ride of stocks going to the moon. So I think that it's a little bit of a complicated, like it's not as clear with a private equity offering. Somebody says, bro, as a woman, please enough with the tatas. Hey. I'm just not gonna say anything. Anyway, so where were we? I think we were here.
Welcome. Nice to have you. You want to talk about lovemaking, right?
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.